Imagine this. Nearly 90% of the money that exists today is not physical cash, but simply digital entries in a bank's database. How is this money created, and why is it crucial for you to understand how the system works? In reality, the process of creating money is complex and involves both central banks, like the Federal Reserve, and commercial banks, the very institutions where we keep our savings. This process directly impacts inflation, interest rates, and the value of your savings. And understanding how money is created can help you make informed financial decisions. Today, money creation is managed largely by central banks, which have immense control over the economy. These institutions are responsible for managing a country's currency, controlling interest rates, and regulating the amount of money in circulation. The Federal Reserve, the European Central Bank, and the Bank of England are all examples of central banks that play a pivotal role in the modern financial system. But how do they actually create money? It's not just about printing cash, which is only a small part of the money supply. Instead, central banks primarily create money electronically by influencing the reserves held by commercial banks. This brings us to one of the most critical functions of a central bank, controlling the money supply to balance economic growth and inflation. Central banks can either inject more money into the economy to stimulate growth, or reduce the money supply to prevent inflation. Their decisions directly affect interest rates, which in turn impact how expensive it is to borrow money for businesses and consumers alike. Most people think money is simply printed by the government, but the truth is much more complex. While central banks do create physical cash, the overwhelming majority of money in circulation is created digitally through a process called fractional reserve banking. One of the main ways central banks create money is through a process called open market operations. Central banks like the Federal Reserve buy government securities, such as bonds, from commercial banks. When a central bank buys these bonds, it doesn't hand over physical cash. Instead, it credits the selling bank's reserve account with newly created electronic money. For example, if the Federal Reserve buys $1 billion worth of bonds, it will credit the selling bank's accounts with $1 billion in reserves. This newly created money enters the banking system, allowing commercial banks to make more loans and increase the money supply. Central banks use this method to adjust the amount of money circulating in the economy. If they want to stimulate economic growth, they buy more government bonds, thereby increasing the money supply. Conversely, if they want to slow down the economy to curb inflation, they sell government bonds and reduce the money supply. However, the central bank's influence is only part of the story. Most money is actually created by commercial banks through the fractional reserve banking system. Here's how it works. When you put the money into your bank account, the bank doesn't only hold on to it. Instead, it keeps a part of your deposit, let's say 10%, in reserves and lends out the rest. This is called the reserve requirement. If you deposit $1,000, the bank may keep $100 in reserves and lend out $900 to someone else. That person spends the $900, and it ends up in another bank, where 90% of that is loaned out again. Through this process, the money supply expands. The original $1,000 deposit can result in many times that amount being created as new money through lending. In this way, banks can effectively create money by issuing loans. But there's a catch. This system only works because not everyone withdraws their money at the same time. If there's a loss of confidence in the banks and people start withdrawing their money all at once, the system can collapse. This is what happened during the Great Depression when banks failed and people lost their savings. Today, central banks act as a backstop, ensuring that banks have enough liquidity to meet withdrawals and prevent bank runs. Now that we understand how money is created, let's examine its consequences. One of the most significant effects of money creation is inflation. Inflation happens when the money supply grows faster than the economy's ability to produce goods and services. When there's more money chasing the same amount of goods, prices rise. A clear example of this is the hyperinflation that occurred in Zimbabwe in the late 2000s. The Zimbabwean government printed money excessively to pay off its debts, leading to astronomical levels of inflation. At its peak, prices were doubling every day, and basic goods became unaffordable for most people. Although this is an extreme case, it highlights the dangers of creating too much money too quickly. In more controlled circumstances, inflation can be managed and even beneficial. Central banks aim for a low and stable rate of inflation, typically around 2%. This helps to encourage spending and investment because if prices are expected to rise gradually, people are more likely to make purchases and invest in assets rather than hoarding cash. Another key impact of money creation is economic growth. When banks lend money, it allows businesses to expand, hire more workers, and invest in new products or services. Consumers too can borrow to buy homes, cars, and other goods. This borrowing fuels demand, which in turn drives economic growth. But there's a downside. If lending becomes too excessive, it can create asset bubbles. A prime example of this is the housing bubble in the early 2000s. Banks were offering loans too freely, and housing prices skyrocketed. When the bubble burst, it led to the 2008 financial crisis, causing widespread economic damage. Moreover, the system of money creation is fundamentally tied to debt. Most of the money in circulation exists because someone took out a loan. Governments, businesses, and individuals all rely on borrowing. As long as the economy continues to grow, this system functions relatively smoothly. However, if growth slows or debt levels become unsustainable, the system can become fragile, leading to financial crises. So why is understanding how money is created so important? Because it affects everything from the interest rates on your loans to the value of your savings. The way money is created impacts inflation, economic stability, and even the distribution of wealth in society. We've seen that money has evolved from barter and commodity-based systems like the gold standard to modern fiat currency. Central banks control the base money supply, but most money is created by commercial banks through fractional reserve banking. This system fuels economic growth but also carries risks, particularly inflation and the potential for financial crises. This basic knowledge helps to understand the broader economy. When you hear about central banks raising or lowering interest rates, you'll know how that decision could impact everything from your mortgage to the price of goods in the supermarket. And if you're interested in learning more about the history of money, be sure to check out our next video on the gold standard. Thanks for watching.